Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella, with additional insight from industry veteran Jordan Kimmel. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
And good evening, everyone. I am Michael Hartzman. Today is Tuesday, April 20th, 2021. And as always, I'm on with my partner, Dominick Tavella. Good evening, Dominick. How are you?
Good evening, Mike. Another day in paradise and another show.
Yes. And it looks like you're not recording from your office this evening, so you may actually have a better shot of being in paradise than I do.
Well, looking forward to the show tonight. We got some great guests and a lot to talk about, a lot to get into right away. So we'll do a quick opening and then jump right into it.
Absolutely. So the market looks like what's good news is bad news, because last week the consumer price index had a very robust reading, which really indicates that inflation is definitely on the horizon. As much as the Fed, I think, wants to be in denial about this, inflation is definitely around the corner, and rising interest rates are probably right around the corner as well.
So, the markets last week actually had a good week overall. The S&P was up a little bit over 1%. Portfolios behaved very well during that same period. But we got off to a rocky start so far this week, and the hint for tomorrow is not terribly exciting. It looks like it's going to be another bad day. So we've been talking about a pullback, a correction for quite some time. I'm not sure this is it, but it's certainly going to be a significant bump in the road, maybe this whole week. What
makes me curious is it seems like there's a new headline every day or every morning when I have the TV on in my office that either the Dow or the S&P hits a new high, and nobody cares. Like no one's calling me about it. This is the most stealthiest bull market I've experienced in a very long time. There's just not any jubilation about any of this right now.
I think it's that mentality that we escaped last year. I mean, as we've mentioned in the past, most clients are really shocked that we were positive and very nicely positive last year, they think it's just going to continue. I have been getting some calls, how high can it go? And without getting too wonky, it's really about, can companies produce profits better than expected profits? And we got some pretty good numbers last week. We had companies beat by a very wide margin. Again, this week off to a little bit of a different start, maybe the realization that we can't keep going up forever. We need to consolidate a little bit. We need to take one step backwards before we go forwards. So this is not completely a surprise to us. You and I have been talking about it for several weeks.
Yeah, we have. And, in terms of earnings, companies able to beat earnings now shouldn't really be that much of a headline either, because last year at this time, literally the economy was shut down. So one sector after another was on lockdown. So I don't think the bar is too high for many of these companies to beat earnings. It's a matter of how much do they beat earnings by, and what is their future forecast for future earnings.
You're spot on, Mike. So you hit the nail on the head. So companies should be able to beat earnings from last year with their eyes closed, but analysts are always assigning some number to these companies. There's some expectations, and historically, analysts are usually very slow to increase their earnings outlook. They're equally slow, by the way, in cutting their earnings outlook when things are going bad. But the majority of companies have been beating their earnings forecast, and they've been doing it handily. I mean, overall for the S&P, we were looking at maybe $175 in earnings for the entire S&P. We're hearing whisper numbers now close to $200. So if companies can really produce at this level and maybe even better levels later on in the year, these elevated numbers on the S&P, the Dow, the NASDAQ are justified.
Absolutely, because there's so much pent up demand for the economy to reopen and people to go back to their lives. I think someone was telling me the other day, you can't even get a reservation for Disney World for October. And I think you were telling me the other day that you can't even book a flight to certain cities. That the business travel may never come back. Honestly, I think businesses are saving a fortune and they're loving the fact that they're not spending a fortune on business travel, but personal travel, I think, is going to go through the roof this summer.
And to a point you've made several times, Mike, so I'll give you credit for this one. The amount of liquidity, cash sitting in banks today, and still earning virtually nothing. Clients are searching for some place to put that money to work. And it seems logical, if you're not buying real estate in Florida, that you're probably going to buy stocks in the S&P 500. So there's a lot of liquidity, a lot of money out there searching for somewhere to go. And I made a joke about real estate, but we've seen how hot the real estate market is. Equally hot the equity markets.
Yeah, I love when a client calls me up and says, "Oh, I have $50,000 in the bank and I got $16 in interest." You could beat that, right?
Well, our job is to try, and if the money can sit for a little while and deal with the volatility. And again, yesterday, today, a proof positive that markets don't always go up. My gut feeling is tomorrow as well. We'll see how the rest of the week goes. But stressing, we've been talking about this for a long time. We've been talking about a pullback for a long time. We've been preparing for a pullback for a long time. So maybe in a sneaky kind of way, looking forward to this pullback.
All right. Well, we will revisit that next week. So that was our quick market wrap up, because tonight we have a special guest, returning guest, Harold Bollaci, who's a local attorney on Long Island, a good friend of the show and us personally. And we will be right back with Harold Bollaci to discuss the state of trust in estates.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report.
So I'm Michael Hartzman. We're along with Dominick Tavella, and tonight we're excited to bring back Harold Bollaci. He was one of our very first guests, Harold. I think you were the third guest of the show. It was a cold winter night that night, and tonight we have a beautiful spring evening.
Great to be back. Thank you for having me.
You're welcome.
How you doing, Harold?
Hi, Dominic.
So, Harold, in thinking you being on tonight, I have so many questions, so many things that you could clarify for us, the questions that we get from our clients. But I guess the most basic one of all when it comes to trusts is could you just explain to us the difference between an irrevocable and a revocable trust, and when a client would need one or the other?
Sure. Well, there are several key differences. The first one, by definition, a revocable trust, by definition, can be revoked or amended by the person or persons who create it. Generally, when you have a revocable trust, for example, if I create a revocable trust, I'm going to serve as my own trustee. It allows me to remain in control. An irrevocable trust, again, here by definition, is a trust that cannot be changed. And it's a trust where someone other than the grantor, the settlor, the creator, the person who creates it has several different names or titles. You cannot serve as your own trustee. So that is the key difference. It's the lack of control that the individual who creates it has over the property that is transferred into the trust.
So Dominick and I have many clients who want to accomplish protecting assets either for themselves or for their parents, and they want to protect it from Medicaid or if they need long-term care. But whenever we say to them, well, I'm pretty sure you need an irrevocable trust to accomplish that, then their enthusiasm seems to wane a little bit. So could you describe again when someone would want a revocable trust, what does that accomplish versus an irrevocable trust?
When someone would want a revocable trusts are excellent bloodline planning tools and probate avoidance tools. A lot of my clients these days are consolidating their assets, which include either their primary home, and some people with second homes, especially in other states, as well as their financial accounts, into revocable trusts. And the primary reason my clients are using revocable trusts is for probate avoidance. And for the listeners that don't know, probate is the process whereby a decedent's last will and testament is submitted to the surrogate's court in the county where they passed, seeking the appointment of an executor and permission to distribute their assets for the terms of the will. And it's interesting, we just got a notice from the Office of Court Administration today that all court personnel in New York are to return to work beginning May 24th. So it's been a real challenge during the course of the past year to get wills probated in courts that are not fully staffed. Probate is challenging in good times, but when the courts are not fully staffed, it's even harder. So a lot of clients these days are trying to avoid probate, and they're using revocable living trusts as a way to do that.
And when would they, Dom, I'm sorry, I'll let you jump in right after this. When would they use an irrevocable trust?
Clients use irrevocable trust primarily for Medicaid planning. And that's the process whereby my clients transfer their assets to someone other than themselves to serve as a trustee. Most people appoint their children to serve as their trustees in an irrevocable trust. And in many cases, those children are also beneficiaries of the trust. So it's fairly straightforward. The point of doing this is to achieve the 5-year look back for Medicaid purposes for those individuals seeking to shelter their assets for institutional care.
Harold, unfortunately with COVID, we've lost some dear friends and colleagues, and this whole planning has really come to the forefront. People who really hadn't intended, obviously, or didn't expect to die quite young. Can you maybe touch a little bit on dealing with minor children and in some cases inheriting quite substantial amounts of money, and how you can use trust to protect the children and protect those assets?
Trusts are great ways. That's a great question, and I know we've all lost a lot of friends, and they weren't all old. It's been a very difficult year. Trusts are a way, how to say it nicely, to reach out from the grave and to put some strings onto bequests, both to adults and to minors. So it's very important. I jump up and down begging my clients, if you have children, please at least prepare a last will and testament that has a guardianship provision in it and also has a minor beneficiary provision in it. And a good estate plan will read that if anyone inherits under the age of, a lot of people use the age of 30. In recent years, it's gone up to 40. So if anybody inherits under the age of 30, their share is going to be held in trust. And the trust is created through the last will and testament in some cases. And some cases, it's the client has already created a revocable or an irrevocable trust. But the trust says that when a minor inherits, their trustee is going to hold their inheritance for their benefit. And it includes a standard language that the trustee is to use the trust money for the health, education, and welfare of the minor. And there are principal invasion provisions in there to pay for certain things that may not fall under the health, education, and welfare and maintenance provision. And they also include step-ups where, okay, at age 21, the minor is to receive X amount of principal. At age 25, they get more principal. I like to include language where a minor beneficiary becomes a co-trustee of their trust when they reach a certain age, because that gives them the ability to work with financial advisors like yourselves and get a good understanding of how to manage the wealth that they've come into, unfortunately, sometimes at a young age.
So Harold, I know you rattled off a couple of ages and conditions, but the truth is it's whatever the client decides, right? At whatever age And for whatever purposes, or whether it's interest and principal or just principal at lump sum, I mean, you literally can design it. The client can design it any way they want, any ages they want, any distribution formula that they want, correct?
Absolutely. I can be as creative as the client. And some of my clients get creative and say that my child does not get to take any principal until they complete a 4-year education, graduate from a trade school. They tie it into some life events, and that serves as a motivational factor for the minor. And it also feels that it gives the client the comfort that obviously there's been a tragedy, that the minor is at least trying to accomplish some things in life given these unfortunate circumstances.
Harold, I think another common misconception is a client, I think, is used to the idea they go to a lawyer, they create a will, they sign a will, they stick it in a safe deposit box, and they never think about it again, right?
Right.
With a trust, it's not that easy, right? So just go through the steps. Now a client leaves your office, has a binder with a fancy trust document. What are they supposed to do now? Because they're not done.
They are not done. And that is one of the best questions you could ask about trust planning. I'm sure I'm guilty of it. And a lot of lawyers are guilty of it. We do all the work, and then we say to the client, okay, now you need to retitle your assets into the trust. And for some people, that's very easy, and for some, it's not. When it comes to real estate, I retitle the deed to the house into trust, and then I say, look, you need to take your binder over to Michael or Dominick at Lebenthal, and you need to transfer and retitle your accounts into your trust. And unfortunately, I can't be there with every client and follow up with every client, and things get, I'll get around to it tomorrow, and they don't get done. So God forbid someone passes away, their family comes in with a trust binder and there's nothing in it. It's a beautiful piece of paper, but the retitling never took place. And so it's a challenge to make sure that clients do that and go to their financial advisors and retitle their accounts, and go to the bank and retitle the accounts and get the deeds transferred and recorded properly. It's not a one-off, and unfortunately, sometimes people don't always do all their homework.
So as the saying goes, but wait, there's more, right? Because let's assume we have a diligent client, and let's assume he shows up at our office and we retitle the account, and we now have the John Smith irrevocable trust dated April 20th, 2021. They're still not done, correct? Don't they have to do tax returns, and don't they have to file? Don't they have to file every year? And isn't this
that was a good lead-in. There's always work to be done, and it really depends on what kind of trust you have. If it's a revocable trust and you're serving as your own trustee, the trust maintains your social security number, and the income passes through to you individually. The real hurdle comes at, unfortunately, when you have an irrevocable trust and you've appointed either your children or a family friend as a trustee. Sometimes that trustee isn't aware of the work that they need to do, and that they need to complete and sign forms with financial advisors, and they need to be working with the creator of the trust to make sure that tax returns are filed and that they've crossed all their T's and dotted all their I's. That's a great question. Yeah, there's work involved for everyone. It's worth the effort.
Right.
So I know Mike is being a downer here.
Thank you.
Just being funny. But the reality is that, yes, it's work and there's a lot of value to it. But probably the one objection I get all the time, Harold, and frankly, I'm a big fan of you and the work you do, and attorneys like you. But it's expensive. It's complicated. It's expensive, and I don't want I don't want to spend that kind of money. And the truth is, it doesn't really have to be that expensive. Correct?
100% correct. I analogize my estate planning fees to the value of of an insurance policy. I think good estate planning is a one-time insurance policy that is absolutely priceless. And I cannot speak for other attorneys and their fees, but I think I'm fairly reasonable, and it's well worth the effort and the time. For probate avoidance alone, whatever you pay for good estate planning is priceless, and the derivatives that come from good estate planning are well worth the effort and expense.
So Harold, other than the irrevocable or revocable trust, let's spend a minute in talking about a multiple family or a second marriage, because in our experience, we've also had a trust come in very, very handy when you're dealing with a second or a third wife and children from multiple families. So how do you unwind that knot?
I think trusts are essential for, in the trade, we call them blended families, and that's a second marriage where both spouses have children from another marriage. And what I do with all of my trusts for, again, blended families, the trust becomes irrevocable upon the first spouse to pass. And what this does is it prevents the surviving spouse from disinheriting his or her late spouse's children. Think about it. If you're in a second marriage and your husband or wife passes, a few years go by, and you start thinking, I never liked his kids anyway, I'm cutting them out of the will. Let me tell you, it happens every day, all day. So when you're doing marital planning for a second or third marriage, you make it irrevocable, and that way it ties up anything that you've transferred into that trust jointly with your spouse, and it prevents the surviving spouse from disinheriting their late spouse's children. It's very clever, actually.
And doesn't it also prevent the children from dispossessing the survivor from a home that she may have moved into with their spouse? So it's a two-way street.
It's absolutely a two-way street, and that would depend on whose name was on the deed, but it wouldn't be uncommon for a second marriage for one spouse to move into another spouse's house that person's owned for a decade or more, and they just never got around to retitling the deed to both parties. And if someone passes and leaves just a last will and testament, and I give half to my surviving spouse, the remainder to the kids, your late spouse's children could force the sale of your house because they want the equity in it. This unfortunately happens far too frequently in my practice. I see it more when people pass away without a will, but it's a frequent occurrence, unfortunately, when people pass with a last will and testament, keeping in mind that the family home is usually the most valuable asset. And children may not be all that interested in letting dad's second or third wife stay in their childhood home. They want the money, and they want him or her out.
Yeah.
Unfortunately, Harold, we've witnessed that on more than one occasion. And then to add insult to injury, they may allow them to stay in the home, but if you don't leave them enough liquidity capital to actually pay the real estate taxes and the utilities, they may not be able to afford staying in that home. So creating a trust with the proper language in it and some capital to protect the spouse or the children is a must do. Is a real priority in cases like that.
It's very important, Dominic, and that comes up, and I encourage people to set aside some money for the payment of expenses, because I can tell you that when children have to pay expenses on a house that their father's third wife is living in, or their father's companion may be living in, who he provided for, it gets dicey. They don't even want to pay the cable bill, let alone the real estate taxes or anything else on that house. So setting aside money for the care of that property is important. And this happens also with children who are beneficiaries of a family home, who may have lived in the family home into adulthood and now no longer have the resources to find their own shelter. It's very complicated on many levels, unfortunately. You got to think about it.
It is complicated. I have so many examples of several brothers and sisters, and there's one sibling who lives with mom or dad, and they want to keep the house, but the parents decide they're gonna split the other assets up equally, and the one who took care of mom and dad don't even have the money to keep the house after their parent has passed away. So long-term planning really is very critical, and these things really have to be thought out all of the time.
Well, especially in New York, the adult child is living with mom and dad for a reason, and
Right.
they should be taken care of accordingly. But if the only asset is the family home, their share of that sale probably isn't enough to provide them the type of shelter that they're accustomed to, especially in New York, where everything costs so much more. They may not have the liquidity or the credit to even rent an apartment. There's a reason they were in mom and dad's home to begin with. So parents need to think long and hard about that.
Harold, we're running out of time, so I just want to stress to our viewers, tell us the story, whether it's myself or Michael or you. Tell us what's going on in your world, what's going on with your family, the family dynamics. And then we hopefully can plan this out, and you can draft the right documents to protect them after the fact. So they got to be very honest with us and give us the whole story. We then can work out a plan for them a long-term plan, hopefully that works for them.
100%, and it takes care of everybody.
Harold, on that note, thank you for joining us. Thank you for filling in our listeners and viewers on what's going on with trust and estates, and I'm sure we'll have you back.
Appreciate the opportunity. Thank you.
Looking forward to the next one, Harold.
Thanks, Dominic. Bye, Michael.
Bye. We'll be right back.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets. Now, back to the Lebenthal Report.
Here with an old friend and colleague, it's John Dobosz from Forbes Media. John, thanks for joining us.
My pleasure, Jordan. It's great to see you. We go back many years.
We do, and I have to share, and John, you're really one of the most visible people in print right now with Forbes. You've been at CNN and Bloomberg. You've been around, but we met 15 years ago or more when I was contributing to Forbes, and we stayed in touch.
The Magnet days.
I love the Magnet days are still here. You can see by my
That's awesome.
background.
No, Magnet works. I like those. It was kind of an IBD 100, kind of a Bill O'Neill multi-factor. You had momentum and you had fundamentals. It was great. And I bet you something like that would be working well these days.
And it is. Thank you. It is. It's continued to work. And again, we add the value aspect to the momentum side. But, I will say to you, I'm running 4 separately managed accounts here at Lebenthal. And one of the ones that's getting the most interest right now, and for good reason, is the dividend model.
Yeah.
When we met, John, hey, muni bonds were yielding 9%. Treasuries were yielding double digits. Throughout the whole time since we met, interest rates went eventually to 0, and people need another alternative. So what I'd open it up with is, I know you're running a couple things. You're in the dividend investor newsletter. You run another service which uses options, which we'll stay away from today. But it's more probably
we sell them though. Just to clarify, the options, it's an income strategy.
Exactly.
We sell them against stocks that we already own or wouldn't mind owning if the methodology says these are good stocks. So yeah.
Right. And I understand a lot of people generating income, but what interests me, and I want to go through it, and I also have to say, without talking about all your picks, I saw the ranking of where you stand next to your peer group. It's good to be number one. Why don't you kind of share, if you will, not so much the picks, but the methodology you use, what you look for. Maybe we compare what I'm doing at Lebenthal.
Sure. Before, it is nice. And we're number one year to date. It's been a slugfest. The best thing to be in so far this year has been energy. Although of late, it's been the one that's pulled back the most. Number two, as far as sectors go, is the financials. And it's been a feeding frenzy among the regional banks, for example, because as the yield curve kept on steepening, we were going through a 6-month period there from like September through March, when the 10-year yield went from 0.65 up to like 1.5. It was recently above 1.7, but now it's come back a lot. My methodology is simple and plain, really. It's fundamentally driven with a little bit of, technical awareness, I'll say. And then I also look at insider transactions to either confirm or maybe dissuade me from going a certain direction if I see people either buying or selling. But stocks trade for different valuations of things: earnings, sales, book value, cash flow, enterprise value. You take the debt and the market cap, add it together, and divide it by EBITDA, whatever ratios you like. You look at historically what a company has traded for, 15 times earnings, and it's trading today at 10 times earnings. Well, you look at it, investigate it a little bit more. You want to have it lower, among as many of those things as possible, but just, take sales or earnings. Say, is there a reason why this company should be trading at a lower multiple? Did things go bad? Is there no growth? What's up? And so by doing that, you come across a bunch of stocks that are waiting to get in the game again. They're value stocks. Okay, so value stocks look like bad stocks until they take off, and then they look like growth stocks. So really, in the last year, the reason why we're doing well year to date is because that's been the style value that's been outperforming growth year to date. And as far as capitalization goes, smaller and mid caps have still, even with the past week or whatever, are still ahead of large caps.
Right.
So,
well, John, let me share with you. I always look at everyone's portfolio. I'm going to take the names you shared, run them through my model. We can discuss them down the road. But one of the things you started by mentioning Magnet. And what I recognize is that you could actually take the Magnet stock selection process and just impose it on another universe. And this is the universe we use of companies paying at least 2%, minimum 2% yield. But John, I want to talk about the value trap of sometimes people going into the highest yield, where what we're focusing on is two factors: not only the dividend coverage, but the history of dividend increases and balance sheets. And maybe you want to talk about a value trap where people say, oh, this is yielding 15, 17%. How could I lose? But it's a value trap. Maybe you could talk about that. I'm not sure what screens you use to eliminate
totally. Well, there's a common sense screen. When you get, as you say, up in the double-digit yields, you need to be suspicious of why that is. But if I told you, don't do that, boys and girls, because it's bad, recent history wouldn't confirm my dour opinion of doing that, because look at the oil stocks, look at 2014, 7 years ago. Remember that, when oil was 110, 112,
going to 200,
$25 a barrel. Everybody, Transocean, a old staid company rig turned into a penny stock. Noble, all those, Ensco, those turned out to be kind of value traps, but they're still around, actually, in this much smaller form. And there's you can do ETFs like the oil XOP, I think it is, the offshore, the oil and drilling ETF. Anyway, point of my story is high yields that are not supported by dividends, you can't sleep well at night owning those. However, when you get really beaten down, like the energy sector was, remember oil? People were having to pay people to take oil 1 year ago.
Last year, yeah.
in the spot market. It was just,
Yep.
a 1-day thing, but
Funny.
but really the price did, for the 1 week average was like $20 maybe or less per
Right.
barrel. Now we're up to, it was up as high as 70, I think, and come down a little bit. So, but as far as, magnet or a value strategy, you apply it to, like you said, a universe that makes it worth your while. You're taking your chance on, you need to have a well-diversified portfolio, first of all, because some things maybe won't work out. But you look at cash flow. Is cash flow over the past, several years smooth and easily covering the dividend? Is the company growing sales?
Right.
Things,
Sales, right.
just because it all starts at the top line. If sales aren't growing, then all these other things really can't get much better. So and then that goes back to the strategy too. You say, well, this thing's only trading for 10 times earnings. Usually it trades for 15. What's up? And usually the market overshoots, and it's negative opinions of a company, and then everything goes in cycles. It was hard to believe that oil would have another day, but oil did, right? And oil was, been a really kick butt part of the market for the last 1 year. But I kind of swore off all energy stocks because even stuff
Right.
like Occidental, went to heck. There was a company called HP, not Hewlett Packard, but Helmerich and Payne. They still
know the name.
covered their dividends, but they went from like $80 down to $7. I think.
Right. Well, see, here's the key. What Lebenthal's pride is providing dividends, but safety also. And when they're giving you $1 but taking $2 back in principle, it really doesn't work. So, what we've seen, and I was lucky enough to meet Sam Stovall of
Yep.
S&P 30 years ago. We talked about the dividend aristocrats.
Yeah.
What's really important to us, John, is to provide some stable to increasing principal even and above market return in terms of income. But when those companies increase their dividend every year, and again, when you talked about sales, that's my spot. Companies have to have increasing cash flow. They have to have increasing earnings and margins. And then I love what you're saying. If you could find them at a historical discount to their own price level.
They've got the dividends paid. The cash flow is pretty reliable year in and year out. And, the companies, I'll give you some exampers. I'm not saying these are great right now, but
Okay.
Fastenal, FAST, ever hear of that? That's a dividend.
Of course, the old nuts and bolts.
They're the biggest distributor of nuts and bolts, what they call them, fasteners.
Increase their dividend every year.
Oh, raise it all like clockwork. Every fifth dividend is a hike.
Mm-hmm.
Out of the heartland, Winona, Minnesota.
Yeah.
Anyway, boring companies like that, or Emerson Electric. You've heard of them? They make little.
You know
motors.
what? Emerson Electric is knocking on the door to get into our portfolio. I saw it's in yours. It scores out well. It does pay the minimum plus 2%. And you're talking about Heartland America.
Really, a lot of these companies, the Greenbrier, they just issued some other convertibles, so the stock went down. But they make rail cars. America, I mean, if you wanted like an investing theme right now, it seems that the market got really excited about reopening the economy and bid things up so much in the since November, really, that now, okay, here we are with the reality that things are better. And now, in classic fashion, right, where the market says, "Oh yeah, buy the rumor, sell the news" scenario.
Well, John, I call it. You pay a dear price for a rosy scenario, and I have to just say, for our compliance purposes, we're not recommending any companies here. There's no specific recommendations, but it's all about methodology. Because John, I met you 15 years ago, and we both do the same thing. It's a lot of work. It's a lot of preparation.
Yeah.
A lot of analysis. But the cream does rise to the top. And seeing you in first place among your peers, I know what you shared. I know you're not only satisfied, but people are doing real well using your process. And,
as you know, you get mail, right? Or through some feedback loop, you get people who have made money and done well by what you. That really does make you feel good.
It feels
because these
great.
people, 1 year ago, Jordan?
John, hold
you
on
know?
1 second. We got a couple minutes. We're going to bump up on time. I want to ask Andrew, our crack engineer, to bring on Dom and Mike, who manage a lot of clients, a lot of money. And what's happening right now is there's nothing in the bank. We know treasuries can't increase their dividend. And Mike and Dom are very conservative. And how can we help them is what we're always asking. So Dom and Mike, John's one of the most experienced on dividends. Fire away.
Dom and Mike, good to meet you.
John, how
John.
are you? Thank you.
Thank you.
Thank you for joining us this evening. So we run very traditional balance type model portfolios, ETF, mutual funds. And so we're compelled 60-40, 70-30 between equities and fixed income. And, you know, who wants to buy a 10-year treasury yielding 1.5, 1.6%, or God forbid a year ago, 0.6, right? So we think dividends has a real value added over the next, and I don't know how long it's going to take interest rates to rise, but talk a little bit of what happens to your bond portfolio during an interest rate environment like we are in right now, and then how maybe a dividend portfolio instead, supplementing income, could really help you out.
That's the question of the hour, Dom. The question of the decade or more, really, has been the Federal Reserve has been doing things to make people take risks in the markets to revive things after various crises. You go back to 9/11, the financial crisis, and now it was COVID. And each time you get to a point where you can fill in the blank where you just said, well, who would want to, you know, buy a treasury yielding 1.6% for 10 years? But people did actually. It got down to, you know, 0.65 or whatever. So anyway, the value of bond portfolios takes a hit as interest rates rise. That's just an inevitable truth. But fixed income is an asset class, I suppose, that a responsible person or a steward for someone else should have your money in, just because you said over the long term. You know, we looked at these scenarios and Monte Carlo simulations, and the 70-30 provides, you know, you're never going to crap out totally, and it works. But yes, you could take some companies that are as good as bonds, but truthfully, equities are a different asset class and an entirely different animal than fixed income. You know, they're just ownership. If I told you General Electric was just like a bond about 2 decades ago, you'd probably believe me. If I told you that now, you'd probably slap me. You know, so but anyway, going back to Sam Stovall, Jordan, you were talking about, he has this chart which shows you, you know, how well the market overall does. I'm not just talking about dividends now here, but I'm just talking about when the dividend yield on the S&P 500 index is below the 10-year yield, the market has always been up in the next 2 years. So for what?
Great point, John.
And think about this. Just think about this. If you're a fat cat, a corporation or a foundation or a rich high net worth individual, you can borrow for close to, you know, those minimum rates and the 10-year rate, not exactly, but maybe, you know, you can get money for nothing almost, and put it. What's the proposition? That you stick it in the U.S. stock market, which has never had a 10-year since 1929 to 1955, has never had a 10-year period where things have been down from 10 years prior, and you're getting a dividend yield that whole time. If you do it with a bond, you've got currency risk. You've obviously got interest rate risk. Look at our government. Look at the borrowing that we're doing these days. It's like you ever go to a nice restaurant, everybody's ordering great steaks and drinks, and then you start wondering, hey, where did he go? Did he go to the bathroom? Wait a minute, hey, wait a minute, guys. And so, not to stray from your question, Dom, but really, if you're 70 years old, also, there's no guarantee you're going to be gone next couple of years. You could, you know, you could easily live till you're 100 years old. So I think people can have a little more equity, because over the 7 to 10 year cycle, you know, you've always been made whole. Doesn't mean it's going to be that way in the future.
John,
But-
we're bumping up to a break, but I want Mike to jump in and then we're going to take a break.
Sorry, yeah, I
You-
mean to carry on. but-
No, John, you answered my question, and I'm just looking at the engineer's notes here, Jordan. I think we're pretty much out of time.
Yeah, well, John, listen, it's a pleasure having you. I love the long-term approach you take. I love the perspective you take. I'm thrilled for you with your returns. And what we need to do is go back and forth and look at our portfolios and continue to help each other. And I appreciate the relationship and love the fact that Forbes Media joined us today. And you're doing a great job. Thank you.
Hey, just Google Forbes dividend investor. I'll see you down the street.
I'd love to have
Thank
you
you,
back,
John.
John, to continue the conversation.
Great to meet
We'll
you
give you more
guys.
time next time.
We'll be right back with more Lebenthal Report following the quick break. Thanks so much, John.
Take care, guys.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets. Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with Dominick Tavella. And, Dom, and listening to John, it was really interesting when he was talking to Jordan. These guys, these portfolio managers, they have this process. They have this theme that they stick to. They don't get caught up in momentum. They don't get caught up in headline risk. They just look at the numbers. They tear the numbers apart. And now with computers, it's so much easier for them to really dig deep. It's just fascinating to talk to people like that because, as I said, they don't seem to get caught up in the headlines that most of us do.
And you know what, Mike? They don't fall in love with the name. How many times have we seen that with a client? Oh, my grandfather worked for that company. Oh, I was with them for 20 years. These guys literally could put a piece of black tape over the name. They're looking at the fundamentals. They're looking at the balance sheet. They're screening it through their computer. If it works, it goes in the portfolio. If it doesn't work, it gets kicked out. And if you stick to literally to your knitting, if you stick to the process, you'll just be more right than wrong consistently. And that's how you get your reasonable long-term rates of return.
You know, it's interesting you say that. You say that because I'm paraphrasing now, but Jim Rogers, if you remember the interview we did with Jim about 2 months ago, he basically said, which was stunning to me, I'm a terrible stock picker. You know, he said, don't ask me to pick a stock right now because I looked at the fundamentals, I looked at the numbers, and I looked at the analysis. You know, the names almost didn't matter to me.
And look, we've been guilty. I've been guilty of it, you know, especially if you've had something in your portfolio for a while. God forbid it's actually successful, then you can never get rid of it, right? So clients walk in, oh, I did great, I can't sell it. Or it's doing really lousy, I can't sell it. I'll wait till it comes back. So either way, they can't sell it. And the key is you're losing that opportunity for the next investment if you're not rotating in rebalancing the portfolio. And I think that was a key point with John when we talked to him that, you know, last year, these dividend value stocks really didn't perform very well. Today, they're doing exceptionally well.
Exceptionally well. And that always reminds me what you said about people falling in love with their stocks is I would have a client who insists on buying Apple, let's say at 150, and then they call me at 125. Oh my God, what should I do? And I always like to say, well, if you liked it at 150, you got to love it at 125.
Look, again, people fall in love with the name. And if you love the watch, the phone, God bless, go buy it. But picking stocks normally is throwing darts against the wall and you might hit the bullseye. Or if you're a lousy dart thrower like me, you bounce it off the ceiling and it lands on the floor. So I'll leave Jordan to do all the analytics on the individual stocks. We'll gratefully run the asset allocated portfolios, and I think we'll both be happy with those roles.
I would completely agree, and we'll continue to kind of guide our clients like we do every week through the maze of not only the analytics but the headline risk. Because
and the noise, right, Mike, and the noise.
The noise, yeah, which is code for headline risk. Because at the end of the day, we could talk about all the analysis in the world, but the client is like, oh my God, but what about this? And that is what we, as always, spend most of our time trying to dissect.
So I don't want to end on a downer, but we've had a rough couple of days. It looks like tomorrow is not going to be great. Hopefully our clients are looking at this within the next day or two and reminded that we are prepared. We were anticipating this, and maybe we can actually take advantage of the volatility.
Yep, there's always opportunity somewhere. Or as Milton Konigsberg, the founder of my company, once said, every golf shot makes somebody happy. So even if tomorrow's a down day, we will find some opportunity. Yeah, Dom, think about that. Every golf shot makes somebody happy.
Mike, all I can think about is when I'm playing golf with you, you must be very happy. I'll leave it at that.
On that note, have a great night, everyone, and we'll see you
Great
next
evening, everybody. Stay safe.
Good night.
Thanks for tuning in to the Lebenthal Report. Dominick, Michael, and Jordan will be back for our next program, airing next Tuesday at 2 p.m. Pacific Time and 5 p.m. Eastern Time on the Voice America Business Channel. Until then, have a great week.